Thank you very much, everyone, and welcome to this session. And today we're going to be, now actually I'm going to start with something because I was looking at all of us and I thought to myself, what a wonderful, incredibly talented group of individuals that I am privileged to be sitting here with today. So thank you very much for that privilege to all of you, and thank you for attending today's event. We're going to be speaking about what's next for ESG, particularly in mine financing. We're also going to be touching on carbon credits, carbon pricing, and other innovations to drive sustainable finance solutions. I'm Laurie Clark. I'm going to give myself a 2-sentence introduction. I am the CEO of ONYEN Corporation, which is an ESG reporting system, digitized and quite effective. This is my 6th company. I started, grew, and sold 3 prior ones. I used to be a trader, and all things capital markets. So I understand, in a very visceral way, what the investment community looks for when it is financing projects and endeavors, and what I used to look for and still do, frankly, when I invest. So thank you to my colleagues, and I'd like them to, each of you, please, take 30 seconds to introduce yourself. Michael?
Sure, thank you. My name is Michael White. I'm the president and CEO of IBK Capital Corp. We're a boutique investment bank located in Toronto, Canada. We're in our 33rd year, and our focus is mining and exploration, development, and production. We predominantly raise capital for companies in the metals mining industry, and we do some advisory work, some M&A work. We spun out of Merrill Lynch back in 1989, where the team led Merrill's worldwide mining practice.
Hi, I'm Isabel Vilela. I head investor relations and corporate communications for GoviEx Uranium. I'm also part of the team that is responsible for ESG strategy and implementation. GoviEx Uranium is a African-based explorer. We have 3 projects, 2 of which are in advanced stage of development. They're both fully mine permitted and in really good mining-friendly jurisdictions. Our most developed project, which is the Marouela project in Niger, has 100 million pounds of uranium in the ground, which makes it one of the largest uranium resources in the world. We have just published a feasibility study for that project in September, and we're now in the process of raising capital. We plan to continue that process through this year and next year, and with a view of hopefully starting production in 2025, 2026. We have been practicing and doing a lot of ESG for a long time, but we only really started formalizing it 12 to 18 months ago. It has been a really interesting process. I think it's also a very exciting time to be in mining, a very exciting time to be in ESG. And when you marry the 2 together, it makes it for a really interesting journey ahead.
Thank you very much for inviting me to be part of the panel today. So I'm Claire Dorrian. I'm head of sustainable finance in our capital markets division and post-trade divisions at the London Stock Exchange Group. So we are an exchange group, but much more than that. We are a data and market infrastructure provider. So we did a transaction some time ago with a business called Refinitiv, which was former Thomson Reuters business. So we have huge capabilities across data, indices, around ESG data, carbon research, infrastructure, and that actually we want to make sure that we can leverage for the value of our clients in the capital markets side of the business, which is the exchange part of the group. So, within the exchange part of the business, we operate a number of markets that are available for corporates to be able to list on and to raise capital to support the transition to the low carbon economy or around green finance. And it's my team's responsibility to develop and enhance those markets. And one of those innovations that we did this year was launching a voluntary carbon market. And I know we're going to talk about that later in the panel, so I won't say any more on that at the moment. But we are obviously home to quite a growing mix of businesses across the green economy, and also heavily represented by mining and oil and gas companies as well. So I think we make sure that there are platforms for those businesses to be able to raise finance at the different stages of their journeys.
Right, and hi everyone. So I'm Ignacio de Calonje. I'm a Chief Investments Officer in IFC's Global Energy and Mining team. I'm also leading our sustainable finance practice in infrastructure for IFC. Now, I know everybody knows IFC, but just for the one or two who may not know who we are, we're the private sector arm of the World Bank Group. So we invest in private sector projects and companies in emerging markets. So we invest approximately and mobilize about $30 billion a year. And that's in the form of equity, debt, subordinated, you name it, and across all sectors. But mining has been a key sector for us over the last few decades. So very pleased to be on this panel.
Thank you very much, everyone. And I'm just going to start it off with Ignacio with, we've had 2 COPs in 2 years. And how's the IFC investment policy now changing?
Well, I think it's evolving. It's evolving, due to COP, but more broadly, I think there's a greater conscious of the pace of climate change and the urgency to get to net zero. And I think that has been in society at large. I think even anecdotally, as people have seen changing temperature and weather patterns, I think that's increased the conscience in society at large. And so I think that really has focused the attention. And for us in particular, things that we've done, we have committed now that all our projects from 2025, 100% of every project that we do will be Paris aligned. And there are certain criteria of how we screen that, but that's something that we've agreed to do, along with other multilateral development banks. We've also committed to ambitious targets on climate finance. So what percentage of our projects are actually contributing to mitigation or adaptation? And the target was 35%. Last year we did 36% of all our investments were what we would call climate finance. So we're really sort of ramping that up. More specifically in the mining sector, the mining sector is really interesting because I think there are 2 big trends. There's the climate trend, the COPs, but there's also the geopolitical trends. And I think mining is really at the nexus of those two trends right now in terms of security of supply and climate. And so we're really focused on the mining sector, both as a supplier of critical minerals, but also how to decarbonize the sector. So on supply of critical minerals, we're investing in projects that supply critical minerals. We just announced we're looking to finance a lithium project in Argentina as an example. We're very exposed also on the copper side. But we're also working with mining companies to decarbonize. So we're also mandated to finance a very large renewable energy project in Africa for a large mining company. We're working with companies across different sectors in new technologies such as hydrogen to help them to decarbonize. So very much trying to see how can we help
So how does it align with private capital investment, though? And Michael, you might want to jump in there.
Just a quick question. You mentioned that you're looking at renewable energies. Your fund you mentioned was $30 billion. What's the percentage? And I'm not trying to, I'd like to quantify what that is, just quickly.
Well, so 30 billion is for all sectors, right?
Yes.
If you just look at energy right now, and it varies, renewable energies is the overwhelming majority of our energy investments. We still do gas-fired power plants, but in very special circumstances when there's a requirement in that particular country. But right now, I would say typically 80% of our investments in the energy sector are renewable energy investments.
Okay.
That's very good.
Okay.
So, sorry.
Go ahead. Go, Michael.
I was going to say that we are, in terms of looking at the Paris Accord and trying to meet the 2050 targets, Canada is doing its job. There's a group, it's called Climate Engagement Canada, and it's pressuring the top 40 companies in Canada to ensure that they adhere to those standards, and will do everything in their might to do so. We focus on mining, and so that's my perspective when I come here today. And it's not just the climate targets, although they are critically important, and I can talk quite a bit about carbon credits and what we're doing in that regard, and we will a little bit later.
Yeah.
But in terms of ESG in Canada, it really is. There's a commitment now to focus on the social, and in many parts of Canada, that's First Nations, and so we've begun to partner with First Nation communities through a public company that's led, operated, and controlled by First Nation communities to push the agenda from the earliest stage of exploration right through to development of
Well, that's a great example of how capital providers are changing the way that they assess investment, opportunities and risks. But what are you doing? Like, what other things are you coming to the table with?
Well, I guess we in terms of deploying our own capital, are looking at and again, it's earlier stage for us, earlier stage exploration and resource development. But we are looking for companies that are changing their habits when it comes to engagement with communities, when it comes to their footprint, their environmental footprint, not just in terms of carbon credits, but the disturbance of the land. We push them in terms of rationalizing drill programs, and this is just from our own perspective. There's really in Canada right now, when you're permitted to do certain exploration, and so you can move forward under those
Right.
permits. But we try and rationalize it. The conservation and preservation aspect of Canada's boreal forests, as an example, is one of the number one ways to create carbon credits. The proper management of those forests to create carbon credits in Canada, and can contribute to the tune of 300+ million tons of carbon credits each year. And it starts right with how you treat those forests, how you act within those forests as an explorer.
Right. And what about you, Claire?
Look, I think that we know that corporate leaders are really taking this issue really seriously, and they're paying a lot of attention in terms of how they're reporting and looking at their data. But you see that also happening from the perspective of asset owners and asset managers, portfolio managers and sell-side analysts. They want to engage with corporates around this agenda and understand some of those opportunities and risks. And I think in the mining sector, that is really important as well. Climate governance matters,
right.
And you've got a number of different scenarios that mining companies are having to manage. The shift in demand of minerals, or some of the climate hazards that exist. About 30 to 50% of the production of zinc, iron ore, copper, others, it's all very reliant on water production. And as you've got climate challenges that are happening that are impacting those supplies, then those need to be borne in mind. So I think, absolutely, you can see there's the drive on the corporate side, the drive on the investor side. If you look at things like the indices that are being developed now as well, you've got, the FTSE Russell TPI indices, the Transition Pathway Initiative indices. You've got now sort of reaching 260 billion of investment that's being tracked, and that's passively, money. So you've got the numbers behind it. But I think also, you've got the likes of Brunel Pension Fund, also a huge amount of money towards tracking these indices. I think what's really sort of needed is sort of the visibility around some of that reporting and data that the investors need to be able to make sure that they're making the decisions that are really going to make a difference for.
That's really interesting. When we were in the back, we were discussing how Some of the ESG factors are being impacting M&A strategies and due diligence, and how these factors are likely going to be priced into deals. And I was saying that last year I was part of a $150 million buyout, and I was doing the deal myself. And I remember that at one point we thought everything had been wrapped up. We thought everything had gone through due diligence. And the credit and risk of the finance company came along and said, no, we want you to do an ESG report. And we had this, and all of these factors that have to be reviewed. And it was fine with me. We went through the due diligence, we went through the process, and thank goodness we came out the other end of it. And so we were able to proceed ahead, but it was the credit and risk department at this financial institution that wanted this review. And if it hadn't gone through, and this is the part that we hadn't discussed, if it hadn't gone through, I'm sure that there would have been a real cost in order to meet that obligation, in order to meet whatever had been found within the due diligence process in order to overcome it and close the deal. There would have been quite a cost associated with it. So do they price them into deals? And Ignacio, or Claire, or anyone that wants to take this, what are you seeing?
Yeah, ESG is front and center, frankly, of any financial transaction, be it M&A, be it a bond issuance, etc. I think gone are the days that was a sort of footnote. We talk to many companies who go out, for example, fundraising, and actually when they talk to investors, the first question from investors is about ESG. It's not about the financials of the issuer, it's about ESG. Likewise in M&A, the risks around ESG when you're acquiring a mining asset are huge. I mean, we've seen many assets that have not gone forward, hadn't got the permits, or permits were revoked because of social issues or environmental issues. And I think in the current context of climate change, I think there's even greater link between E and S. I think there's sometimes a debate, E is too important, S is too important, etc. Yeah. The reality is it's one and the same, frankly. If you've got water scarcity, it's going to impact your communities. If your communities aren't using the water in a sustainable way, that's going to impact, et cetera, et cetera. So I think all these issues are critical, and actually they are very much part of a due diligence, be it for debt, be it for M&A, and they have very clear price implications. Because if you're not taking care of that, the universe of buyers reduces drastically, and when you reduce the universe of buyers, guess what happens? Price comes down. So it's very clearly at the forefront, I think, of everybody's mind.
We're just if I can pick up on
that. Go ahead.
I mean, we're looking at going forward. So not old assets that are being bought and sold, but new discoveries, the mines of the future. And in terms of our portfolio, it's nickel in Quebec and Ontario. And in that regard, we are very much viewing ESG as a value add. I sometimes get a bit annoyed when people just label it a cost. Well, of course it's a cost. Everything that we do is a cost. It does come out in that sense, but it can also add a tremendous amount of value. And so when you're looking at potentially multi-generational deposits that are new and on the forefront with metals that will be literally fueling our planet in the future, then you have to start from you have to embed that right at the beginning, and it has to be a top-down approach. The CEO of the company, the chairman of the company, she has to make sure that it is embedded in the organization, and then it becomes of great value, because those are the assets that are going to be consolidated and bought by the larger companies, and you will get that premium.
Well, sound business practices are sound business practices. I think that ESG has just, if we got rid of the ESG anachronism, I think it would just be sound business practices, and that's what you have to do. And Claire, to that point, how are new and emerging regulations shaping sustainable finance, and can mining companies meet the hurdles?
Yeah. I think there's a lot of change in regulation in this space. There really is. You've got more and more companies setting net zero targets. You've got TCFD becoming mandatory, climate transition plans as well in the UK. So and that's in addition to perhaps sort of industry evolution and regulation as well happening. But I think what is important to sort of note, I think, about this at the moment is that some of this, the voluntary data and the voluntary part of it isn't necessarily working at this stage.
No, it's not.
You've got too much of a data gap in terms of disclosure around Scope 1, Scope 2 emissions. I think we did some research. Our colleagues in the FTSE Russell part of our business has said only 42% were disclosing Scope 1, Scope 2 emissions. And so you need, what happens then is you plug some of those empty gaps with estimated data, and that's not going to help investors either. So you've got to get the data side, working really well. And so, this issue is something that goes beyond, carbon emissions data. It goes into green revenues data as well. So, there's some particular elements that we've been really articulating with policymakers globally that we think needs to happen to make sure that companies are reporting the right information and investors are receiving the right information. And that is about actually, how can we get some more mandatory disclosure around TCFD reporting,
Right.
and make sure that it also, that relates to the ISSB recommendations. So we're really standing up behind those. Also to make sure there's more increased data and disclosure around green revenues, because I think that will also help with the investor understanding about the direction the business is going. And also mandating climate transition plans. I think that is really going to be the three key areas for us that we
one of the things, I come from the capital, like I said, right from the beginning, and I remember in the 1980s and 90s, the regulators came down very, very hard on the capital markets and said, instead of, we're going to try to do this voluntary disclosure, and they just wouldn't. They just would not follow through and do what needed to be done. And the capital markets today in Canada reflects the outcome of what happened by not disclosing. And so it really was, the independent dealers, pretty much they had to be bought out, because they just refused to do what needed to be done in order to run sound business practices within their corporations. And I'm wondering if the regulators are going to come down like a ton of bricks on companies here, mining companies. And I'm going to give it over to you, Michael, and whoever wants to take this. Ignacio as well. Do you think that the regulators are going to overregulate?
Well, there's always the risk that the pendulum swings too far, right? And to your point there about regulation in the 80s, if you go far enough back, just to give it an example, insider trading was legal, as an example. If you go back to the 60s, it was just, if you did your homework and you got information before someone else, it's okay.
Yeah.
Right. We've come a long way since then. In the exploration and mining world, we've also come a long way because of things like BRIEX. Now we have a very standardized way to report your resources, whatever the metal might be, and it's generally accepted. Everybody knows the framework in which you have to exist, and without it, you are not going to get the money that you need to continue to explore, develop that asset. It's just the way it is, and I see that with we've seen it in accounting as well. We were all happy under the generally accepted accounting practices, GAAP, and then a few bad actors came in, and now we have IFRS, and so you adjust and you move forward, and it's done for the better and the greater good, and that's in my mind ESG. It'll become woven into the fabric of what we do as mining companies and exploration companies going forward, and I really see it as a positive, and I don't look at it as overregulation.
Okay, so I'm going to turn it over to Isabel now, because
yes.
you're in the mining world, you're the miner, and you haven't piped up yet, and so we need to. I want to understand how are these how are companies. How are you doing with all of this investor scrutiny?
I think that there is a lot that companies sort of can do in order to address that scrutiny. I mean, one of the first things to bear in mind is that you have to understand where that scrutiny is coming from. And if you look closely, you will see that it's not just from investors or lenders. You have customers, so people like Apple now requesting recyclable gold from the supply chain. You will have your employees, you will have, in our case, our off-takers will have very varying degrees of things that they will request in terms of our ESG disclosure. So understanding where it is coming from and what's required from you is the first step. I think the second step is giving yourself enough time. I think that when we started formalizing this process 12 to 18 months ago, I perhaps naively assumed that we needed quite a lot of time because we needed to gather the numbers together. And that's important. Yes, you need time to gather the numbers, but one of the reasons why you need time is because ESG is so much more than just environment, social, and governance. It's about risk management. It's about putting in place a set of rules, regulations, and its procedures and processes and policies in the workplace so that you can manage that risk. It's about creating a system of continuous improvement in your company. And that takes time because you have to completely change the way that you think, and that has to seep through from top to bottom, bottom to top. So time is definitely an important consideration. And I think that that's probably it. These are the most important things that you have to think about. Actually, it's also an ongoing process. It's a bit like, I think that for us, we realize that ESG is a bit like housework. It never finishes.
Don't talk about that.
and it is, you have to just continue. When you start, you realize very soon that you're very far from where you want to be. And then as soon as you are closer to where you want to be, you realize that you have to move again. And I think that we are all going to slowly realize that this is all encompassing and it will continue.
Okay. Now we have a Slido. And a Slido, we have some questions for you, and we want you to participate. And what we want you to do is to actually, once you see the Slido thing in the back here, I want you to get your phones and take a picture of the QR code. And then with your phones, we'd like you to answer the questions. And we'll see what the result is. You can see it over here. Okay, that's good. I don't have to crane my neck.
Should we do this too?
Okay. So are you going to do it, Michael?
Why
Go
not?
ahead.
Why not?
So we'd like to see what the audience thinks of this particular question. And the question is, which sustainability topic do you prioritize when making investment decisions today?
Everything.
Well, what is it?
it?
Wow.
Well,
Yeah.
I mean,
Let's see.
we're being honest.
That means it's really embedded in the business then,
Oh,
isn't
wow.
it? Yeah.
Look at this. Okay. It's moving around a bit. Okay. And is everybody done? Not really. No? Okay, I'm just looking over here because I can't see the printing over there.
50%.
Okay, so it's all of the above is the winner at 45%. Is it 45%?
Yep.
Yeah.
And then what else? Corporate governance is at 23%. So leadership skills is only 18. Therefore, we can all relax.
Well, I think.
But yes, and actually,
So what were we going
potential
to say?
climate.
What were we going to say? It's surprising.
impact.
So it's surprising that community engagement is only 5%.
5%, isn't that
especially in
interesting, isn't it?
mining projects.
And
Yeah.
climate impacts is only 5%. It went down.
I wish we could ask another question. Like corporate governance, I think some people, and I'm not saying that it's not, but I think some people might think that that's almost your foundation, which the E and the S can sit on. Because if as a corporation, as your culture within the corporation, if you're not running with that, then what do you have, right? You know what I mean? If it's
Yeah,
not the
yeah,
foundation,
The other thing is ESG is not binary. It's not like
It's not binary.
You know?
Exactly.
Yeah.
Yeah. And Ignacio, you look like you were going to say something.
No. For me, frankly, leadership skills and corporate culture are fundamental. And we've seen when there is dedicated leadership that sees the long-term vision, understands the things. I mean, I always put an example of Mark Cuttafani at Anglo, and obviously now Duncan is doing a great job. But the way he embedded sort of ESG considerations across the organization, and it's never perfect, right? Any large organization or mining company will have issues, but I think leadership, is key to make sure that all these issues are given the right importance across the organization. So for me, that would be probably the starting point.
Right.
All the others will flow from there, I think.
Okay, so now we're moving on to carbon credits and carbon pricing. And is this the way forward? Is it the way forward for the mining industry? Claire?
I'd say it's a part of a way, yes. Because if you think about the goals and the targets are being set around net zero, it's going to be very hard for businesses to be able to get there without looking at the residual emissions. So I think from the stock exchange's point of view, our and we've done some work in this space, and I can share that with you in a minute. But I think it is about decarbonisation first of all, and running potentially that alongside a parallel strategy of looking at carbon offsetting to address the residual emissions. And particularly in heavy emitting sectors, I think there is a role to play there as we transition to the low carbon economy. And that is why we, the Stock Exchange, chose to venture into the voluntary carbon markets ourselves. Not to set up a platform to trade the carbon credits, but actually a very different part of the market to support the financing going into the climate change mitigation projects that generate carbon credits. So we've designed a set of market rules that are going to enable the listing of carbon funds or operating companies to utilise the London capital markets.
That was going to be my next question, is how do companies determine which carbon credit scheme is actually the appropriate one?
Yeah. Well, look, this is a way. This is one other. Will now become another additional way in which investors, whether those be institutionals or corporate investors, can procure carbon credits. Because imagine you've got a fund that lists on the London Stock Exchange. That does an IPO, comes to market, is invested in a series of nature-based projects, or it could be a combination of nature and carbon-based carbon capture projects. That vehicle is listed on London markets, and then investors can purchase into that fund, buy an equity share, and trade that. And in the future, could potentially receive a dividend in the form of a carbon credit.
So are we seeing the start of a carbon exchange?
I think this is an industry, right? It's not just an exchange. It's going to be a series of exchanges. And it's a remarkable opportunity. Specific to mining, we talked to mining companies about this issue because we are large shareholders in a company called Big Tree Carbon, which is producing carbon credits through the preservation and conservation of the boreal forests of Canada. So we with the first two contracts that they've signed, we can produce 1 million tons carbon credits per year. And that can be sold into the compliant market. So we're talking, because we do mining, to mining companies. And these mining companies all have their want to do it organically. They say, well, we may need carbon credits to get us through the next few years, right? In terms of, but we want to get down to zero. So it's not net zero, it's just zero carbon footprint. I mentioned those new nickel mines that we're looking at going into production. They actually have, as part of them, tailings that extract CO2 from the environment naturally. You throw the crushed rock as tailings onto the ground, and it pulls CO2 into it. There's an argument that, in combination with hydroelectric power, you could be actually at zero without the use of carbon credits. But there are lots of other industries out there that can't do that. We don't have battery-powered airplanes right now, as an example. And if you go online and you book you go online, you have the option, it's voluntary, but you have the option to purchase carbon credits to offset your trip, as an example. And there are lots of other industries out there, like the oil and gas industry, like some critical industries in terms of infrastructure. The consumer goods, transportation, These are industries that are producing a lot of CO2 and therefore have large CO2 footprints. They're going to need offsets for years to come, right?
Isabel, would you consider a carbon credits strategy? Small companies, small mining company?
We looked into it, and I have huge respect for anyone that drives the sustainability agenda, and I can understand the need for carbon credits. I don't think it is something that we wanted to do. I think that as a small company in this industry, there is an opportunity for you to design your mine in the most sustainable way possible, and to look at renewables, to look at ways to be more efficient. And so, yeah, I don't want to be controversial, but I'm not a huge fan.
It's okay to be
I'm
controversial.
not a huge fan of carbon credits. I can understand that, being pragmatic and like you said, there are some industries where you have no way around it. But it is definitely not something that we are considering for the moment.
And I think that's a view that you certainly do here, because you've got some companies are at very early stages of a net zero journey. They haven't worked out the full roadmap yet, or
right.
even so they are more concentrating at the moment of actually looking at doing that materiality assessment around understanding their scope 1, scope 2 emissions. So you're not going to get some companies thinking about offsetting until a few years' time. But actually, if you've got some of the infrastructure right now for when those opportunities might happen in the future, I think that's what's really important to make sure you do. So you're generally seeing sort of the voluntary carbon markets evolving and maturing at all different parts of the value chain. And that's around recognising different, new projects. You talked about the quality of the offsets and how those are being recognised.
Well, it's becoming law too, right?
Yeah.
Canada passed it as law, and we're increasing the value of a ton of carbon offset by $15
That's right.
a year to $170 per ton. We're at 65 right now. So this is a legitimate legal business, and it's a great opportunity to focus on ways in which we can help reduce the carbon that's in the atmosphere.
Okay. Well, so I'm going to ask all of you to weigh in on this. What's the most important insight that you would like to share today? And I'll start with Ignacio.
Why are you picking always on me?
I like to.
No, just kidding. I think for me, there has been a sea change over the last 2-3 years. Again, I think people are now very much focused. I think it's great, people putting out net zero targets. I think for me, the key issue is it is complex. It's people have to recalibrate constantly, and people will make mistakes in that recalibration. But I think as investors, as lenders, I think we need to engage with companies. And I think in that engagement, we will hopefully get to change. But it's going to take a lot of work. But it's an exciting moment, I think.
Right. And Isabel, I'm going to jump around a bit. Isabel, what about you?
I think that it's important to sort of bear in mind and always go back to why we're doing this in the first place. Mm-hmm. If you look back,
well said. Well said.
Yeah, ESG started, many decades ago in the form of CSR and health and safety. We then moved on to more wishy-washy, greenwashing, etc., to now becoming more regulatory. But we all have to, take a step back and think, okay, well, what's the right thing to do? And as long as you focus on that, you're probably going to the right place.
Yeah, and that's really what it's about. It's just good business, practices. Michael.
Yeah, I'll follow that along by saying we're not viewing it as cost. We're not viewing it as friction. We're viewing it as value add and reducing friction amongst all those, the E, the S, and the G, and everything that's kind of woven in between the E, the S, and the G. And therefore, it's not something to begrudge, but something to embrace. And we think that along the way,
Yeah.
as long as you can embrace this and as long as you can use it to your advantage in the sense that you're not just doing the right thing, but you're bettering the corporation that's doing whatever it is that it's doing, then that's tremendous opportunity.
Well, that's right. And Claire, just for 10 seconds,
Look, perhaps building on a little
because
bit
we're
what
out of time.
we were both saying, I think it's about keeping that actually the forefront of mind is actually what we're trying to do here is to save our planet for future
That's right.
generations. And so you need the dialogue, you need the communication between companies, you need the blended finance between private and public capital, and you need to make sure that you've got the right data that is out there, so
Yes.
people can make the right
And
decisions.
that's why, and to that end, go ahead,
Sorry, so-
Michael has to get the last word in.
500 of the top money managers out there represent $105 trillion.
Yes.
And if we as an industry can help shake that money out,
That's
loosen
right.
up
That's
those
right.
coffers and have it flow into
And
what
to
is
that point, actually,
a critical sector of society.
The most important
then we're
comment
doing
I
the
can
right
make
thing.
today is that I was talking to one of my customers, and they got $100 million, $100 million because they did an ESG report, and they did it on my system, and I was damn proud of that. That is what we contribute to the mining sector and the mining world, but not only mining, because we serve all companies around the world. But $100 million is a big number today. And when I heard that, I was really, really happy. So that's what I wanted to share with everyone, because the money is there. You just got to get it in the right way. Okay? Thank you very much.
Thank you.
And thank you all.
Yeah, that's great.